Hey guys, welcome back to the channel. Today I want to share with you a behind the scenes lesson that we did on the platform that every trader, and specifically every trend continuation type of trader, needs to see before getting into the market. Now before we start, I want to share some special news. We are back with another big live event. So save the date, October 25th, 26th, 27th, 3 days full of education and training. Online, 100% free. We'll shoot you details on how to register and stuff in the future, but mark your calendars, save that date because you want to be there, and trust me, you want to be there live. All right, let's hop in. I want to start off on the euro dollar here because I think it was a cool example of a conversation we started 2 days ago. We followed up a little bit on the chat yesterday, and I thought it'd be a good opportunity to talk about it today. And the conversation has really been about, the difference between the what and the where, right? So whenever we talk about the what and the where, the what refers to the thing, whether it's a Fibonacci, whether it's an AB equals CD pattern, whether it's an impulse leg, whether it's a double top or double bottom, a flag or pennant, right? The what is the actual thing. So think the pattern setup or the technical move. The where is the location, right? The where is that thing occurring at. And in order to be a successful trader, what we want in our grade A trading opportunities, we want the what and the where to align. Meaning we want the what to happen, which is the thing that we value, and we want it to value at a location in the market where it makes sense in whatever our trading expectations are. When you have one without the other, there's not really much you can do, right? You have the what without the where. The what is not really that not powerful because it's not at a great location. You have the where without the what. You can't really get involved with the trade because typically the what is what you require. So that's a lot of what's right there, but you want everything to align. And we were talking a lot about impulse legs, and one of our traders is looking at a strategy where there are impulse legs and using impulse legs for trend continuation setups. And we've been trying to help that trader take a step back and not worry so much about the what and kind of go back to the basics, go back to the foundational elements of the process of analysis, because that's going to be the most important thing that tells you if a trade setup is great or not. So euro dollar was a good example lately because we've done this, and I think we may be looking at the same thing. So if we look at the 4-hour chart here, we're going to see a handful of moves, right? We're going to see a move down here. We're going to see a move retracement. We're going to see an extension. We're going to see a retracement. We're going to see an extension. And we're currently putting in a retracement, right? So 4-hour chart, we have extension, 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 or impulse leg, impulse leg, impulse leg. We are currently putting in a retracement. If someone is a trend continuation trader looking for a bearish move, they're probably looking to hop on this retracement and trade it down. Would you guys agree? Would that be the bearish trend continuation move here? Hop on this retracement, look for a reason to sell here and trade it down, right? So that is the what. The what is looking for impulse leg, retracement, sell. Impulse leg, retracement, sell. And again, that's a nice method. That's my personal method of trading. I'm a pullback trader. I like to wait for the pullback where price gets nice and cheap. And I look to get involved in the next move. Where the where comes into play is this. How do we know if we should expect this next move? Right? In order to profit, we need price to come down and extend. How do we know if we should expect an extension or not? Should we just assume that the market is going to extend down? Is that a safe assumption that we can make? Well, no, right? Maybe if you're trading an index or something like that, where typically the S&P will always trend up forever. It goes through its dips and whatnot, but in most other markets, the majority of the time we are in consolidation. So this is the question we want to answer. Again, if we want to make profit, we need this move to be made. So the question is, why are we expecting this move to be made? And what is our answer? Why are we expecting a move downward? Do we have an answer for that question? Or what is your answer for that question? Because this is something that traders actually need to ask themselves. And too many traders don't. Too many traders just look for the thing, or they pick out a particular point, or we see it with stop losses a lot, where it's like, I'm going to put my stop loss 5 pips above this level. I'm like, well, why? Why is your stop loss there? And I'm like, because it's 5 pips. But a lot of us, and again, I'm guilty of this as well, a lot of us will do things on the chart without an actual reason for doing things. And sometimes we know there's not an actual reason for doing things, but we want to get involved in the move, so we kind of like ignore it. But sometimes we just don't know what we don't know. We just, heard like, hey, this is what I should be doing. A book told me this, or a YouTube video showed me this, and I'm doing it. But there should be reasons. It's no different than investing in something that you are unknowledgeable about, right? I talk to a lot of first-time investors and kind of help them get their feet wet in the market. And one of the first things I tell them is invest in something you know. Now, it's the biggest piece of advice. One of the biggest pieces of advice is I got, right? If you are not familiar with like biotech stocks, don't start hunting around for biotech stocks. You don't know. Pick something that you know, ideally something that you use and can understand, and it'll be a lot easier for you to start investing. And then you can kind of branch off from there. So the question is, previous structure support, now resistance. Is it? Previous structure resort and resistance tells us that we're likely to extend. So I like that mindset, but here's the question. Did we break previous structure support? And if I take a look out on my chart and I zoom out, and I have this green line there because I was actually looking for a double bottom there. Where are we currently trading at? If I look left, we know where that green line's at on this side. I'll zoom out a little bit more so you can kind of see both at the same time. Where are we currently trading at, guys? Did we violate previous structure support, or did we test and hold previous structure support? 100 out of 100 traders should have the same answer on this. Did we violate previous structure support, or did we hold? Are we holding? What would you guys say? It's an easy answer because we have black or white rules. Yep, it is a hold, right? We zoom back into that green line. We have not broken and closed below that green line, so it's a hold. So price action, you look at support and resistance as being, let's look at it like a brick wall, or like, how Peter Brandt says it's an ice zone, right? Where this is support and resistance, depending on what side you are. If this is like a frozen lake, right? If you are a fish underneath, it is resistance, right? It's stopping you from breaking above. If you are above, it is support. It's supporting you and stopping from falling through, right? In our case, this is support because we were traveling down. We have not violated it, right? So if we have not violated it, if we have not broken through this ice, or even put a crack through it, however you want to picture it in your brain, do we have any reason to believe that price is likely to continue lower? And remember, we need price to continue lower if we're ultimately going to profit. And the reason we're trading is not for giggles, right? It's the profit. So if we have not broken through this ice, which is our green line here, and we know that we would need to break through our ice in order to feel confident that price is going to continue lower, since we haven't done that, do we have any reason to believe that it's going to happen? What would you guys say? So yeah, because we have not violated structure, I don't see any reason to believe that price is likely to go lower, right? Structure has come to the ice and we have held, just as we have last time. There's no reason to believe that price is likely to go lower. Because there's no reason to believe that price is likely to go lower, do I want to put myself in a position where I have my hard-earned money pushed into the market like chips on a poker table, and in order to get that money back, I need price to go lower, aka I need price to do something that I don't actually think it's going to do. Do you see the issue there? So these are the questions that we need to ask ourselves as traders. And we spoke about it Tuesday. There's a very simple process to making sure that we have all of these questions answered, right? One, go back to the basics. Go back to Foundation Course 1, go back to Foundation Course 2. Train yourself, right? Train yourself, and we put these courses in order for a reason, right? Everything is in order for a very specific reason. But train yourself on the foundations of reading a price chart, starting with candlesticks, starting with basic trends, starting with support and resistance, and learn about the relationships between all of them, right? That will give you a massive amount of knowledge on just the basics of how to read a price chart, how to determine if we are bullish, if we are bearish, if we're more likely to continue bullish, if we're more likely to continue bearish, if we're more likely to reverse. All of those questions will be addressed there. After you have that knowledge, that's going to help you with your decision making on the market. Because now you know, hey, if I'm a counter trend structure-based trader, I need to look for this. But if this happens, red flag, run away. If I am a trend continuation trader and I'm using pullbacks, I need to look for this. If this doesn't happen, red flag, run away. And now we've added that where element to our trading, where we can put ourselves in the best trading positions versus putting ourselves in positions that don't work out, and then we're scratching our head trying to figure out, man, how come that didn't extend? Only to look back and see like, hey, there's no reason to believe that it would extend. But 4-step process. You're tired of it, I know. But it's here for a reason. IPDE, identify, predict, decide, execute. Identify what the market is doing. This is you reading a price chart. This first step would have kept us out of trouble in this trade, because when I go to my higher time frame, whether it's the 4-hour or daily, and I zoom out and I identify what price is doing, my answer is price action came down to previous structural support and is currently holding. Right then, I know my trend continuation opportunities are nil. At step 1, right? Right then, if I'm looking for bearish continuation opportunities, I know that I don't have them already. Just by step 1, just by the first question. See how important that process is? We don't even need to get to step 2, 3, 4, or 5. Step 1, I already know. Now I can set up my future trade. I can say, okay, well, we're currently trading here. But if we do this, then, right, we can start planning out in the future, and that's fine. That's something that you want to do. But as far as trading opportunities right now, all right, let's identify what price action is doing. We came down to previous structure. We held that structure. Nope. That's it. And we just stopped ourselves from doing anything that's going to get us into trouble. So if you haven't tried the process, try it. But again, what's more important is we need to understand the basic rules of price action first. The basic rules, the basic laws. That's going to help us not only determine if we are in good situations versus poor situations for what we want to happen, but it's going to add a massive amount of consistency to our trading. And that way you're not going to get into trouble where it's like one time you see this, but the next time you see that, and the next time you do this, the next time you do that, right? You're following the same rules, the same laws, you're following the same procedure each and every time. You become mechanical and methodical in the market. And like any great business, consistency is the key to making profits. Or as I say, consistent analysis plus consistent execution equal consistent results.